We were profitable every quarter this year, which I think is very important given what the economy has done in the face of the pandemic. The diversified business model that we rolled out 5 years ago, I think, demonstrated its value, where an investment bank reacts differently than a consumer bank to an economic cycle. And whilst our consumer bank struggled and brought down that profitability, in large part because we took significant impairment charges to build a reserve, the investment bank actually had a return on capital in the year of over 13%. That's kept the bank profitable each quarter, allowed us to print, as you noted, the highest capital ratio ever for the bank at 15.1%. We continue to target over 10%. And I would just, people should remember that in the last decade, our consumer business in both the UK and the US consistently delivered a mid-teens to high-teens return on capital. That will come back. This pandemic has been, challenging to say the least for everybody, but it will pass, and the profitability of our consumer businesses will come back. We feel very good about where our investment bank is positioned, the market share gains that we have taken, and I think that bodes well ultimately for the underlying profitability of the bank.
Jes, are you excited about what we're seeing in the yield curve at the moment, the steepening of the yield curve in the States, a little bit in the UK as well and elsewhere as well? Is there something happening there that's going to actually boost net interest income, net interest margins going forward?
Yeah, I think that's a double-edged sword. Obviously, we've had the pandemic, which created an extraordinary economic shock. But it's been met by an extraordinary response in terms of fiscal policy and monetary policy. And I think you have to give governments credit for reacting with such strength in the face of this pandemic. But to a certain extent, it was financeable because interest rates were so low. And you can increase your deficits without much pain if interest rates stay that low. So one risk, given the level of government spending, is if interest rates do start to move up markedly. That will increase the cost of trying to respond to the pandemic. For Barclays, obviously, low interest rates are tough for a bank. So if interest rates do start to move, there'll be clearly a positive momentum for us there. But it will be tougher for the overall economy.
Jes, last year, Barclays upped the minimum repayment on credit cards, and I know there were some public groups that were a little bit worried about that. Can I ask you specifically, did you do that because you're worried about rising delinquencies? And the second question really is, are you worried about rising delinquencies going forward once we get beyond government support schemes for public that have been affected by the pandemic?
I think what is actually quite remarkable is how resilient consumer credit has been. And what we see in actual delinquencies is much less than one might think given the scale and scope of this pandemic. So no, we're not concerned there. In fact, our spend has gone down a lot. So balances have actually come down irrespective of our initiatives. And we hope that they go back when the economy recovers. But I think consumer credit will show much greater resilience this go-round than what we might have experienced in the past. I also would say, given technology today, we have a much better understanding of the financial strength or the financial situation of each of our consumers, and that allows us to manage credit more intelligently than we could in the past.
There's a line in the statement, the decision to leave the EU may give rise to further economic and political consequences, including for investment and market confidence in the UK and the remainder of the EU. Come on, just give us your impression what's going on here. Is the EU being bloody-minded about equivalence, and is that going to have real bottom-line impact on you potentially over the rest of this year?
Barclays, we've had to adopt to creating a ring-fence bank in the UK. We had to adopt to running what's called an IHC in our US business. Brexit will clearly, and has clearly created Europe as a separate bloc from the UK. We've invested in our bank in Ireland, which now oversees all of our European branches. We have moved personnel to cities across Europe. But London has got a lot of strength and advantages to it. It's still a major financial market and will continue. And I think ultimately both the UK and Europe realize cooperation is in the best interest of the European Union and the British government, and we'll find a solution to this.